Welcome to Big Picture Earnings Analysis. Today we're locking on to Marvell Technology, Inc.
Ticker MRVL.
And it is a huge quarter to break down. We have their Q3 fiscal 2026 results, a look at their Q4 outlook, and a really massive acquisition they just announced.
An acquisition that, might completely reshape their position in the AI data center market.
Absolutely. So let's jump straight into those Q3 results. This is for the quarter ending November 1st, 2025.
And the headline number is a new record.
A new record. Net revenue hit $2.075 billion. That's up 37% year on year.
And importantly, it beat their own guidance. Came in about $15 million over the midpoint, which shows they're executing really well.
But before we go any further, we have to talk about the income figures.
Oh, we absolutely do, because on the surface, they look almost unbelievable.
Right. The GAAP diluted income per share was $2.20. That translates to a GAAP net income of $1.901 billion, a massive number.
But that number has a huge asterisk next to it. I mean, it's driven by a massive non-core event that you really have to understand to get the full picture.
Okay, so let's unpack that. This isn't from selling more chips, is it?
Not at all. The lion's share of that comes from the sale of their automotive Ethernet business back in August.
Right, that divestiture. It brought in $2.5 billion in cash.
And resulted in a pre-tax gain of $1.8 billion. So they basically streamlined their business, and that one-time event is what is inflating the GAAP income.
So to get a clearer view of the actual, operational semiconductor business, we have to look at the non-GAAP numbers.
Exactly. The non-GAAP definition is key here. It strips out things like amortization and, crucially, this one-time gain. And that number was a very strong $0.76 per share.
And that's where the operational strength really shines through. Non-GAAP gross margin was at 59.7%.
Which is a fantastic number for a semiconductor company. It shows they have pricing power and they're scaling efficiently.
And the cash flow from operations was also really strong at $582.3 million.
And here's the connection you, the listener, need to make. They sold that automotive business for $2.5 billion in cash.
Okay.
And the upfront cash payment for the huge acquisition we're about to talk about, $1 billion.
But they're not just having a good quarter. They are literally funding a massive high-stakes acquisition in cash with the money from selling a legacy business.
It's a perfect exchange of old assets for future growth. It just tells you everything about management's conviction and where they see the future.
Okay, so with that funding context, let's look at what's driving that core revenue. Segment by segment, the data center is still the absolute king. It brought in over $1.5 billion.
Which is, what, almost 3/4 of their total revenue?
73%, yeah. And that segment alone grew 38% year over year.
And while data center is the anchor, the growth elsewhere is kind of staggering. It shows a real rebound in spending.
Like where?
Carrier infrastructure, it almost doubled, grew 98% year over year, and enterprise networking jumped 57%.
Wow. Those are huge numbers.
They are. The only part of the business that declined, of course, was automotive and industrial.
Down 58%, but that's completely expected because of the sale we just talked about. They intentionally cut that branch off.
Exactly. Now, on to what the market always obsesses over forward guidance.
Right. For Q4, they're expecting net revenue of $2.2 billion, give or take 5%. So continued growth.
Management is clearly optimistic. The CEO, Matt Murphy, he came out and said they expect full-year revenue growth to exceed 40%.
40%. And they even raised their long-term forecast for data center growth.
They did. Said it's now higher than they previously expected, and they pointed directly at AI as the driver.
And that profitability is holding up too. Q4 non-GAAP earnings guidance is set around 79 cents per share.
So yeah, the momentum is undeniable. Strong quarter, great guidance.
Which sets the stage perfectly. They have the money, they have the momentum, and now they've made their big move.
The strategic pivot.
The acquisition of Celestial AI. Marvell themselves are calling this a transformational milestone.
And it's a move born out of necessity, in a way. I mean, for all their success, Marvell has been seen as underperforming some peers in, let's say, the highest growth parts of AI.
So this is their big shot to leapfrog the competition.
I think so. They're trying to solve the single biggest bottleneck that's limiting AI scale right now.
And what exactly is that bottleneck?
It's connectivity. It's the wiring. Modern AI systems are these massive multi-rack clusters with hundreds of processors, or XPUs.
XPUs being the general term for GPUs, custom AI chips, things like that.
Right. And the traditional copper wires that connect all these powerful chips they're running out of steam, they consume too much power, the latency is a problem, and they can't handle the bandwidth.
So the connections can't keep up with the processing power.
Precisely. And we need to be clear here. There's scale out, which is connecting racks to each other.
Okay.
And then there's scale up, which is the really hard problem of connecting chips inside the rack. Super high speed, super dense. That's where the industry has to go all optical.
And this is where Celestial AI and their Photonic Fabric technology comes in.
This is their secret sauce. It's a platform designed specifically to nail that scale-up problem. We're talking about moving light, not electricity, between the chips.
And the advantage is just raw performance.
It's staggering. Their first chiplet provides 16 terabits per second of bandwidth in one tiny little chiplet.
16 terabits. Can you put that in perspective for us?
It's a tenfold leap. It is 10 times the capacity of the current state-of-the-art 1.6T ports that are widely used today. And on top of that, it's more than 2 times as power efficient as copper.
Wow.
In a hyperscale data center, power is everything. That kind of efficiency is a game changer.
Okay, that performance jump is massive. But integrating photonics, light-based tech, directly onto silicon has always been tricky. What makes this solution different?
It comes down to thermal management and packaging. This is the real IP they paid for. Celestial AI's tech has this incredible thermal stability.
And why is that so important?
Because it allows the photonics to be co-packaged vertically. You can literally stack them in a 3D package right next to or on top of these incredibly hot, high-power XPUs and switches.
So it's about getting everything closer together.
Yes, which maximizes bandwidth. But the really clever part is what it does for the XPU itself. By integrating vertically, you free up all this valuable space on the edge of the main chip.
The beachfront property, as designers call it.
Exactly. And you can use that new space for more high-bandwidth memory, or HBM. More memory means more processing power for AI. So this one technology solves connectivity, power, and memory bottlenecks all at once.
That really does sound transformational. So let's talk about the price tag for this transformation.
It's a big one.
Marvell is paying about $3.25 billion upfront. That's $1 billion in cash, which we know where that came from, and $2.25 billion in stock.
And that's not all. There's another $2.25 billion in potential payments tied to hitting revenue milestones. So this is a deal that could cost up to $5.5 billion.
For a company whose technology is still, getting to market, that's a huge valuation based on potential.
It's incredibly aggressive, and
Yeah.
the risk is all about execution and timing. They don't expect this deal to even start adding to their non-GAAP earnings until the second half of fiscal 2028.
That's a long time to wait for a return on a multi-billion-dollar bet.
A very long time. And their revenue forecasts are just as ambitious. They're projecting a $500 million annualized run rate by late fiscal 28.
And then for that to double to $1 billion run rate just 1 year later, by Q4 of fiscal 29.
It all points back to what you said earlier. They feel they need to make a massive move to leapfrog the competition in AI. They're betting that this deep co-packaged optical technology will become non-negotiable for hyperscalers sooner than anyone thinks.
They're trying to become the essential must-have provider for how AI processors talk to each other.
It's a brilliant high-stakes play.
So what does this all mean for you, the learner interested in where all this infrastructure is going? This report shows a company not just banking profits, but actively mobilizing them.
Right. They're using today's record earnings to fund a complete technological pivot for tomorrow's AI data centers.
And that raises a really important question for the entire industry.
It does. Given the immense power demands of these multi-rack AI systems, if optical connectivity becomes the necessary foundation for true hyperscale, will the thermal and packaging advantages offered by this photonic fabric technology become the single critical limiting factor, forcing all major AI developers to adopt this kind of co-packaged optical solution much sooner than anyone predicts?
The future of performance might not be the chip itself, but the light that connects it.